On the 60-minute chart, we reversed up very strongly, and we have a reversal, a bull flag, a breakout, and there's an expanding triangle, different ways to draw it, 1, 2, 3, 1, 2, 3, and a reversal down. But after a pretty tight bull channel, the bears typically need at least a micro double top. We sold off pretty sharply, so big up, big down, big confusion, and more sideways is likely. The bulls will probably need at least a bigger double bottom than what they have here over the next few days. So we're probably going to have a hard time resuming up, and probably will have to test back down to this general area. The bears will see it as a lower high major trend reversal, bull trend, bear breakout, lower high, and the bulls will hope that it becomes a big high 2 buy, leg 1 pullback, leg 2, and for trend resumption up. The buy climaxes on the daily, weekly, and monthly charts, the combination of 3 buy climaxes that the market has never seen, at least in 90 years, is unusual. While it can get more unusual, it's unlikely to continue much more. And even though the daily, weekly, and monthly charts are all in strong bull trends, and any one reversal attempt is likely to fail, the odds are high that one will succeed at some point in the next couple of months. The market's constantly trying to reverse when it's in a bull trend, and all the reversals fail. Eventually one will succeed, and because of how extreme the daily, weekly, and monthly charts are, I think the odds of them becoming much more extreme are small. Right now we had a small wedge top after a buy climax. The bulls bought it. We had a failed breakout above the wedge top, and the bulls bought that. And if we go above yesterday's high and a new all-time high, it'll be another wedge, 1, pullback 2, pullback 3. However, as I keep saying, as overbought as it is, picking the exact top is very difficult. In fact, it's impossible, because most tops are going to fail. Yesterday, we had a sell-off down to the 60-minute moving average. When the market pulls back to the 60-minute moving average, it often falls 5 or more points below, and it's still simply a pullback. When it pulls back to the 5-minute moving average, it pulls back just a few ticks when it's in a strong trend. But when the 60-minute chart is in a strong trend, the pullbacks are often several points below, yet the bull trend is still valid. We have big up, big down, big confusion. The odds still favor higher. The bulls see a double bottom bull flag, and if we fall below yesterday's low, they'll see a big high 2 bull flag, 1 pullback, and then 2. And the bears are trying to create a credible trend reversal. They had a lower high major trend reversal here, and then a double top, and then a bigger double top here, and now they'll try to get a bigger, another lower high, and what they hope is a bear trend. This is a major lower high. We have a very strong breakout below a prior low, and therefore it's a magnet. For the bears on the 5-minute chart, they can argue that it's either in a trading range or a bear trend, as long as it's continuing to form major lower highs. And therefore, they do not want the market to get above this lower high. If it gets above there, then the bears conclude the bull trend has resumed, and then we're either in a trading range in a bull or bull trend. So the bears are trying to keep the market from going up here, and they want at least a second leg down, and they're hoping that this is the start of a 5.5% correction, but the odds are it's not. Yesterday was a bear inside bar, but a very small body. For the bears, it's a sell signal for a double top and a slight failed breakout, but a doji bar, just like these 3 doji bars, usually does not lead to a trend. It usually leads to more sideways trading. That red line is a measured move based upon we have a breakout above this high, a pullback, so a gap, a little bit overlap, negative gap, but it still resulted in a measured move up. This is the weekly chart. So it's a measured move up on the weekly chart. And here's the weekly chart. Same thing, measured move up. We're right there. So it's a resistance level, but a very tight bull channel. Therefore, the first reversal down on the weekly chart will be a bull flag. We should get below the weekly moving average, which is about 100 points below where we are. I think we're going to get down to this breakout point and test it. We tested it here and rallied strongly, but on the daily chart, this was I think a bad test. Here's that test on the daily chart of this breakout point. A big tail with only a little bit of overlap. Usually that is not an adequate test, and usually the market has to test it again, and therefore there's a big magnet down here at this low, almost 100 points below where we are. For the bulls, they see a bull flag and a breakout on the daily chart and a pullback, so a high one buy, but a bear bar, not a very good buy. So probably it's not a good buy signal bar, so probably sellers above, and not a good sell signal bar, so probably buyers below, and that increases the chances that today will be a continuation of yesterday's sideways trading. Tomorrow, 11 o'clock, there is an FOMC announcement, and FOMC is always a catalyst. A catalyst means it can be something that leads to a big move in either direction, up or down. And the market usually tries to get neutral going into the FOMC report. For the bears, they have a failed breakout above a 4-hour trading range and a decent sell signal bar, but we barely broke out, and bar 1 already closed the gap above 77. So there does not look like much energy, and because it opened just a little bit above the trading range, it's not overstretched. It's not stretched too far to the upside. I talked about this last week. Bar 1, the high of the day is the open of the day, and only about a 20% chance that it will continue. So 80% chance we're going above the high of bar 1. Last week, the weekly chart, that's the first time I ever remember a similar situation on the weekly chart where the week opened on its high and it traded down, outside down last week. And then in the middle of the week, it started to trade up and it got all the way back above the high. So by the end of the week, the open was no longer the high of the week. And here we open on the high, and the open is the high of the day, but 80% chance it will not remain the high of the day. 80% chance we're going to get above it by the end of the day. For the bears, it's a lower high major trend reversal, another one. Here's one, here's one, here's one, here's another one. These are double top, lower high major trend reversals. This is, is it a small expanding triangle? Maybe. But in any case, small bar, barely above the top of the trading range. Not a lot of energy in the market over the past 4 hours yesterday. And more likely, this is not the start of a big trend up or down. Bears trying to trigger the sell for the failed breakout above the trading range. But look what's right below. 60-minute moving average, 5-minute moving average, 15-minute moving average, all are within a point of one another. Yesterday's close, the bottom of the trading range. There are many support things not far below. For the bulls, they see this as a breakout above the trading range, but that's a terrible looking bull breakout, right? You don't want a bull breakout bar to be a bear bar closing on its low. They see 2 as a pullback from the breakout and therefore a buy signal bar. And sometimes you'll get an opening reversal up from a trading range and not from the moving average, but usually opening reversals come from around the moving average. What to do right here? I think wait for more information. It's a sell signal below 1, but not an overstretched market. It's basically a small breakout above the top of the range. And for the bulls, it's a high 1 buy above 2. I would wait for more information. Going below 1, possible high of the day, going above 2, possible low of the day, but the bars are small. We're in the middle of yesterday's range, and yesterday spent most of the day going sideways. and that all increases the chances that we'll have a lot of sideways trading again today, especially going into the FOMC meeting on Wednesday, and then the unemployment report on Friday. Weekly chart so far is a doji bar. Daily chart yesterday was a doji inside bar. Today could be inside of yesterday as well. Yesterday's range, kind of an average type range, looks like about 12 points. So today could easily be a 7 or 8 point range day inside of yesterday. Four bars in a very tight range. So today has an increased chance of a continuation of yesterday's range. So in other words, today probably will be another trading range day. On the daily chart, 4 of the past 5 days were doji bars, so they closed around their open. If we get up near yesterday's high, probably bears will sell a reversal down. Today might be an inside day. If we get above yesterday's high, yesterday's a bad buy signal bar on the daily chart, probably sellers above. If we get near yesterday's low, bulls will buy a reversal up, trying to keep the day from going below yesterday's low. If we get below yesterday's low, we trigger a sell signal on the daily chart, but a bad sell signal bar and terrible context for a breakout. We're sideways, and therefore bulls will buy a reversal up. Right now it looks like we'll be in a trading range day. Trading range days usually come in 2 types. One is a very tight range with lots of small reversals, and then the other is more of a reversal day, 2 to 3 hours down or up, and then 2 to 3 hours in the opposite direction. Yesterday was a little bit of both. We sold off, and then the market was in a tight range with lots of reversals for the final 5 hours or so. For the bears, we have a small double top 12, but a terrible stop entry environment, and the odds are we're going above we have a tight trading range here with 4 bars, but terrible stop entry environment, a very tight range. The odds are we're going above the high of bar 1, and the bulls want to get at least 2 ticks above the high of 1. That would increase the chances that we'll try to get up to the next resistance level, which is 22 high, the top of that sell climax, and yesterday's high. Bears micro double top, but not a very good stop entry sell. There's a magnet at the 1 high. We did not get above it. I'm going to check on the other computer, I'm going to check the CME website because of TradeStation does not show every tick. Most brokers do not show every tick, and therefore you're never sure where the high is. I'm trying to check the other chart. No, this is actually the high. I just checked the CME website, and this is the high of the day. So, in fact, the day did open on its high. We have a tiny double top, and the bulls are trying to get a tiny double bottom. Best choice is to wait. You can argue it's a double top and a failed breakout above the top of the range, and therefore a possible high of the day. And it's a reasonable short, but the probability is less because the range is so tight and because we did not get above the high of 1, and the odds are we will get above the high of 1 at some point today. So rather than selling here below 4, I think it's still better to wait. Bulls are trying to get a high 2. 2 legs down, 1 and 5. In the old days, I used to get upset about this kind of an opening, because I'd want to make a lot of money. And when you see this kind of an open, the odds are that it's going to be it's going to be a fairly quiet day, and it makes it harder to make a lot of money. So it would feel unfair. I'm so eager to get to work and trade aggressively and do really well, and then I see a day that looks like it's not cooperating, and now I just don't get upset by anything. I just look at it and say, oh, look what it's doing today. And just scan through stocks to see if there are any interesting stories. I just quickly look for big gap up or big down, big percentage moves up or down on the daily chart. So Qualcomm, I saw a story before they opened that Apple might stop using Qualcomm chips, and so that's why that took place. Micron, bull flag, very strong breakout. I'm just looking at the percentage gains or losses. Okay, that looks like it. Possible high of the day, like a double top, failed breakout of a trading range, but not yet a high probability sell. And part of the problem for the bears is that we did not get above the open of the day. You know how I talk all the time about how the market tends to do the same thing, for several days, sometimes several weeks, and so it gets into wedge mode and starts doing a lot of wedges, or it gets into trending trading range mode, or it just gets into a very tight trading range, or it gets into big swings or a lot of reversal days. This is another example of it. We're getting several days over the past couple of weeks that have either opened or on their highs or on their lows. Today is another example, opened on the high. This is at least the third one that I can remember over the past week or two. Here we opened on the low right here, and here we opened on the high. Are we always in short? Well, if the market closes down, here we are. Okay, so we're probably always in short. Bulls are hoping for an opening reversal up from the moving average and a 50% pullback from this rally. And the bears want to get below the trading range. They want to go outside down below the trading range and get below yesterday's low. While always in short, the bars are still not all that big, so there's still not a lot of energy. Bulls trying to get an opening reversal up from the moving average, a high 2 legs down, 1 pullback 2, and the bears want a second failed breakout of yesterday's trading range and a swing down. They want to get below yesterday's trading range. 6 is an important bar. We're already almost 3 minutes into the bar, and it's not a second big bear bar. And therefore, this is not as bearish as it could be. The bears wanted to get this, urgency. They wanted to get, immediately big consecutive bear bars, increasing the chances that will go lower. And we're not getting it. So right now it's a pullback, 50% pullback from this rally down to the moving average, and the bulls are trying to get an opening reversal up. For the bears who sold below 4, it depends on what their goal is. If they're scalping, they're already out. If they're swing trading, they have to make a decision if 6 is a bull bar closing on its high. Do they get out because of the opening reversal up from the moving average, or do they keep their stop above the high of the day and hold, hoping that we come all the way down here? So let's say 6 is a bull bar. If the bears keep their stop up there, they're risking 2 points to make an extra 1, 2, 3, 3 or 4 points, and they need at least a 40% probability of success, which they probably will have, even if 6 is a bull bar. So therefore, it's okay for the bears to hold short, even if 6 is a bull bar, and even if 7 goes above 6. Would I hold short if 6 is a pretty good looking bull bar? I would not. And for the bulls, they will buy above 6 if it's a good enough bull bar, if it has maybe a 3 or a 4 tick bull body closing on its high, or an opening reversal up from the moving average. Right now I think it's slightly more bearish than bullish, but in the absence of consecutive big bear bars, it's really not all that bearish. We have consecutive bear bars, 4 or 5, but we do not have a follow-through bear bar after the bear breakout on 5. They're fighting over 1 tick. Will it have a bull body or not a bull body? Okay, bull body reduces the chances of this being the start of a bear trend. And it, like I said, then creates a high to buy setup for an opening reversal up from the moving average. Not a very good looking buy, not a very good looking sell. I think not worth buying, and the bears, they have to decide, do they get out above 6 or keep their stop above 4, or wait to see what 7 looks like. If it starts to go up 2 or 3 ticks above 6. You have limit order bulls who bought the 3 low. They bought more 1 point lower. So we're probably getting up to the 3 low. And then we have to see, does it get 1 tick above the 3 low and allow limit order bulls to make money? Or are the bears able to keep a gap, keep the 7 high from going above the 3 low? That would increase the chances that we're going down to the bottom of the range. So 7 is an information bar. Chances are we're going up to the 3 low, and then we find out, do we go 1 tick above it, which reduces the chances of a swing down, or do we fail to get above it, which increases the chances of a swing down? You see that? It went above 6 and then below 6, and now it's trying to go above 6 again. If it does, that creates a small wedge. I know it does not look like a wedge, but the market went down on 1, up on 2, down on 5, up on 6, down on 7, up on 7. So it increases the chances for the bulls. Best choice, probably flat. And however, I think a lot of the bears will get out above 6 on the second time we go above 6. So a lot of the bears will see this as bad for their case. You can see the 3 low, right? You got the scale in bulls who bought there and bought more lower. They needed to get 1 tick higher. Some bulls bought 1 tick below 6, and they had to bounce 5 ticks for them to make 1 point, which it did. So we know some limit order bulls made money. Suppose it now goes back below the 7 low. That would be a failed breakout below a wedge. I'm talking about a wedge. You really can't see it on this time frame, but let me take a look at a smaller time frame chart, like a 1 minute chart. So 1 up, 2 up, 3 up. But everything is tiny and not a lot of profit potential yet. Do you feel like we're waiting for the close of the bar again? Like on bar 2 and bar 6. So not a lot of urgency. The bears are maintaining that gap. They're preventing the market from getting above the 3 low. So at some point, the bulls who bought the 3 low and 1 point lower have to give up. So we went below 6, above 6, and now, actually I think we went above 6, below 6, above 6, and now back below 6. Next stop is yesterday's close, and bulls will continue to try to turn this into a wedge bull flag. Always in short, likely to go at least a little bit more down, but all 3 moving averages are flat and sideways. Next target is close of yesterday. Usually on the open, if the market is near yesterday's close, it tries to get there. Yesterday we tried to get to the close of Friday, but could not quite get there and reversed down from a wedge. And if we reverse up here, it would be a wedge test of yesterday's close again. I think most traders should just be flat and wait for more information. Bulls trying to create a wedge opening reversal, 50% pullback of this gap up and test of the 2 moving averages, but they need a pretty good buy signal bar. If 8 has a 2-tick bull body and it closes on its high, that would be an okay buy for a possible low of the day. But a lot of small sideways bars, tight trading range here, tight trading range here. It makes it difficult to do much. The profit potential is small. The probability is not very high, and the risk is relatively big compared to the profit potential. Bears want another gap, 9 high and 7 low. Not a good buy signal bar, but for the bulls, it's a wedge bull flag. So bull breakout and high 1, high 2, high 3. Close the gap below 7. Not looking like the start of a big bear trend day. So bear leg in a trading range in search of the bottom of the range. We're at support, but do not yet have a good buy signal bar. If you're a bear, what do you do? If you did not get out above 6, do you get out above 8? Do you keep your stop above 4? You stop above 7? The math is, I think, very marginal here. It's very difficult to structure a reasonable trade, long or short. Still slightly more bearish than bullish, but not very bearish. Still on the swing short. Not a very good looking buy, so a lot of bulls will not buy above 9. But it's a wedge pullback from the breakout above yesterday's range, and we're at the 60-minute moving average. It makes it hard for the bears to hold short if it gets above 9. Bulls need at least a couple bars up to convince traders that we're back to always in long. For the bears, I think it's better to get out, even though we're still in a bear channel. We're at support. We're forming a wedge pullback from the breakout above the top of the range, even though it's a bad buy signal bar, 9 in a tight bear channel. I think it's just really hard to justify holding short. The math is just not good enough. And for the bulls, possible low of the day, but tight bear channel, not a high probability buy. Better to wait to see if we start to get consecutive big bull bars or some kind of a double bottom over the next few bars. Okay, the market's telling us that today's going to be a pretty quiet day. Getting near to the end of the first hour, and you can see we had 5 small bars yesterday, and so far today's a small bar. It's at the top of the trading range, but it's a little bit of a breakout above the top of the range. Let's say 11 closes on its high, then we're probably always in long. The bears have a hard time, I think, justifying holding short, even though you can argue we're still forming lower highs and lower lows. You can see we're struggling with the 3 low. Some bulls bought more 1 point lower, 2 points lower, and this looks like we're going back above the 3 low, which means the limit order bulls will have made money. And you don't want that if you're a bear. You don't want gaps closing and bulls making money. The bears want a double top 7, but the consecutive bull bars and 11 closing on its high, probably barely enough for always in long. Well, just like not a great sell for the bears on the way down and very difficult to hold short, not yet a great buy for the bulls. So really not compelling reasons to trade here. Back above the 3 low, so the bulls who bought with a limit order at the 3 low, and the bulls who bought 1 and 2 points lower, and the bulls who bought the moving average now have all been able to make money. We broke above the top of the range and reversed down. Tried to break out again, reversed down. Trying to break out a third time. The bears want the lower high, but unless 12 is a pretty good bear bar, the odds are there will be buyers below and at least a small second leg up. Again, I think this is not good trading. It's very difficult to do much here. And most traders, I think, are better off just waiting. Probably buyers below. The bears want a double top 7 and a bear channel with lower lows and lower highs, but a big enough reversal up, I think, to weaken the bear case and make it more likely that our buyers at the 12 low and lower. The bears are still hoping that all of this is a bear flag. So bear trend, and then bull channel, bear flag, and second leg down. So they want trend resumption down after this strong sell-off. But it's really pretty neutral. I think right now a 5-minute chart is slightly more bullish than bearish. Bears want sell-off, trading range, second leg down, sell-off, a wedge bull channel or any kind of a bull channel, second leg down. So this is more like today. The bears are hoping that the rally is weak and that eventually we'll start to get a series of bear bars and a second leg down. So bear trend, bull channel, mostly sideways. So bear trend, bull channel, second leg down, and the bears want second leg down. Bear trend, trading range, second leg down. Sell off or rally, second leg down. Bulls want sell off into a bull flag and a reversal up. Here's a bear trend resumption. So trading range, second leg down. Actually, I get this listed under the trend reversal. We got a bull trend, trading range, and trend reversal. It's that as well, but it's also a bear trend, trading range, trend resumption. Anyway, this is, I think, of all the possibilities, this is the most like what the bears hope will happen. So bear trend, rally, but not very strong, and then eventually a bear breakout. Here we got 3, 4, 5 bear bars. The bear bodies are getting bigger, and for 5 bars, when that happens, the momentum down is increasing, and it increases the chances that you'll get lower prices. Bears, bear trend, weak rally. They're hoping it's a bear flag, and that we get a second leg down. So leg 1, pullback, leg 2. They have major trend reversals here. You can call this whole thing a big major trend reversal. It's just not clear yet. Neither side has clearly taken control, so it's still neutral. Sideways for about 5 hours. Lots of little reversals. It briefly looks bullish, then it looks bearish. For the bears, micro double top, it went below 12 and then back to the 12 high and then below 13, the neckline of the micro double top. On a smaller time frame chart, that's probably a little double top, 1 minute chart. So here it is, small double top. Bulls have bought the 12 low, still have not yet made 1 point. They probably will. I think we're always in long. We have a magnet at the high of the day, the 1 high. Most days that open on the high trade above the open at some point. Bears want a wedge lower high, reversal down, second and then third, but still slightly more bullish than bearish. Best choice for most traders, flat. The bars are small, the range is small, and the profit potential at the moment is small. small range, so potential for the range to double. The range right now is 4 points. If it were to double, it'd be 8 points, and that might be too much to expect on a day that is as quiet as this has been. Wedge rally. Bulls want a bull breakout and a measured move up, and the bears want a double top 12 or a failed breakout above 12. Not a very good looking sell. I still think we went always in long on 11, but most of the bulls who bought scalped. You can see we're 5 ticks above the 11 close and we're pausing, and that's exactly how far the market had to go for those buy the close bulls to make 1 point. And for the bears, a wedge lower high, top of a trading range, so a double top. They are looking for a measured move down to below yesterday's low, but not a particularly good looking sell. Only one bear body in the past 8 bars, and it's only a 1 tick bear body. So low probability sell, but it looks like most of the bulls who bought the 11 close or 12 low or 13 low are not willing to hold. They're scalping. So that reduces the chances of the market going much higher. Still always in long, but a weak bull trend. We can always get a sudden breakout, right? And the one high, if we break to a new high, this is the 18th bar. This is the 18 bar range. And right now, there's a 90% chance either 1 will remain the high of the day or 9 will remain the low of the day. If we start to reverse down over the next few bars, even if we get a 1 or 2 bar breakout above 1, traders will sell, betting that the breakout above 1 will fail and become the high of the day, and that will break below the low of the day. If we get a reasonably strong breakout above 1, traders will buy the breakout if it's a buy the close rally, not likely, or they'll look to buy a pullback, betting that the market will not fall below the low of the day. This is what I was talking about. When a day is very quiet like this, a lot of traders will not buy on a stop above the 18 bar range because there's at least a 50% pullback, probably a 60% pull. There's probably at least a 60% chance that there'll be a pullback or a reversal within a bar or two. So a lot of traders wait to see if we get a strong breakout and then buy the strong breakout, or they wait to buy a pullback. Breakout of an 18 bar range, pretty quiet range, and this is what followed. Again, another small quiet day, breakout of an 18 bar range, did not get very far. However, bulls could make money buying pullbacks. Same thing, another quiet range, breakout, did not get very far, bulls buy pullbacks. Bigger bars, consecutive bigger bars, higher chance of a measured move up on the breakout. Again, bigger bars and big breakout, and the bulls got a big move up. Even today, even this is more trending behavior than today. 3 consecutive bear bars, a couple of good bull bars, another good bull bar. A break above the 18 bar range by 1 bar, and then a reversal down. Very quiet trading. I think more quiet than today. Bulls got the breakout, but it became the high of the day. 1 bar breakout above the 18 bar range, and this is the remainder of the day. So you can see that okay, these are the same thing. I'm trying to see which is more instructive. breakout of the 18-bar range, bulls bought the pullback. Breakout of the 18-bar range. Here's bar 18, broke out again. Yet this is the follow through. So you can see here, late breakout, 18-bar range. More trending price action than today. Even then, the breakout did not get all that far. So you can see that when you get these small, quiet days and you get the breakout, the follow through is not all that good. So always in long, yes. Bull breakout, yes. Can you sell here? Because the odds are we're not going all that higher without pulling back. You probably can, but I think it's better to look to buy the pullback than to sell the breakout. You always have to be thinking about a possible small pullback bull trend whenever you see gaps in a quiet day. A gap there, a little bit of a gap here, and then a gap here. What happens if we start to get 3 or 4 consecutive bull bars, even if they're small? Then traders will buy closes. We had that yesterday. It failed, but they bought the closes. And we had it over here, and it was successful. The market went a lot higher. A breakout in a tight channel, we went higher. A breakout of a bear channel and a tight channel, and we reversed. But even if you bought up here and held, if you scaled in lower, you could have at least avoided a loss and probably made a small profit. And that is why we're going higher. Bulls are not sure if we'll pull back at any point over the next 5 or 10 bars, and they don't want to miss the entire trade, so they go ahead and buy small. And then if it does this, they buy more lower, betting that it'll be a minor reversal and get close to the original buy. And they get out at the original buy around break even, and then with a small profit on their lower buy. And this is why they buy, because they're afraid of missing a move that could go up several points. Limit order bears selling 1 high and 1 point higher. Bulls hoping that the gap stays open. We're getting a lot of bars here closing on or near their highs. We're always in long. I do not think we'll get a reversal down. I think right now 90% chance 9 will remain the low of the day. And that means that we're either in a bull trend, which we are, or in a trading range, which we don't know yet. We could break out and then do this for the remainder of the day. Break out and sideways to up, but mostly sideways. Break out and then sideways. Similar to today, break out, second bar, big tail on top. $22, a bigger bar, so a little bit of a buy climax, a break above the top of a tight bull channel. However, better to either be long with a stop below 14 or 9, looking to buy more lower, or waiting to buy a pullback. When a channel is this tight, the first reversal down is usually minor. Sometimes it's deep, like yesterday, but still minor. Bulls will buy it expecting a test back up. Looks like a lot of the buy the close bulls are scalping. By the 20 close, by the 21 close, had to go up 5 ticks for them to take 1 point out, and went up 5 ticks in a climax and is pulling back. So a lot of the bulls are scalping, and that reduces the chances of a big rally from here, it increases the chances of a pullback and a trading range. Tight channel, so any short is a scalp, and I think most traders should not yet be selling. Limit order bears who sold 1 point above 1 probably will make money, but the bulls will try to keep the gap open. They'll try to prevent the pullback from falling below the 1 high. Eventually, we'll probably get there, but we might not get there on the first few bars down. You can see here breakout bear bars, but it took a lot of bars before the market pulled back below the breakout point. Over here, so it took more than an hour to pull back. So it took an hour before the limit order bears made their money. Bulls buying the reversal even after the buy climax, trying to trap the bears. Again, this is probably what we're going to get, a tight range or some kind of a trading range. Less likely a protracted bull trend. This day had more energy, more consecutive big bars up and down, so a higher chance of the day becoming a trend day. Same here, higher chance of a trend day. A lot of sideways bars, a lot of prominent tails, breakout sideways for over an hour. Since sideways is likely, bulls will buy below bars and scale in lower, and bears will sell above and scale in higher. Because the channel is tight, I think it's better to be a bull. You can either buy with limit orders, buy at the market, and use a wide stop, or you can wait to buy with a stop after 3, 4, or 5 bars of pulling back like this. If we get 2 big bear bars, a lot of bulls will not take the first buy, and then once they see a tight trading range, they will not take any stop entry buy, they'll wait. "15-minute Globex chart, expanding triangle, 1, 2, 3, but a pretty tight bull channel, so not a very good stop entry sell. Expanding triangle. Bulls trying to get another gap, but the odds are we're going to trade back below the 1 high either soon or at some point today. What do traders do? It's always in long. However, we can get a deep pullback like yesterday. We had a tight channel, a deep pullback, tight channel to get a deep pullback, somewhere in the middle of the range. So any bull buying needs a wide stop, and they're probably better off trading small. And for the bears, I would not sell with a stop here. We might get 3 or 4 consecutive bear bars, and that could, if they're big enough, it might make it always in short. I don't think so. This channel is so tight that even 3 consecutive bear bars, we're probably still going to be always in long. Tight channel, first reversal down minor. Big bear bar, 3 bear bars. They still bought it because of the tight channel, minor reversal. So trading range more likely than bear trend. Here we got 3 bear bars, but minor. They bought it. We got a lower high out of it. What about stop entry bulls 25? Well, they can. I think if you're buying for any reason, the 23 low, the 22 low, the 23 low, the 24 low, above 25, you need a wide stop. We're probably entering a tight trending range, and we might pull back, maybe a 50% pullback to the 19 low. Buy climax, its low is always a target. Limit order bears so far trapped. They sold one high, sold more 1 point higher. It had to get down 1 tick below the 1 high to make money. It did not, and therefore bulls hope this is a breakout test that leads to a measured move up, and that will make some bulls buy above 25. But while that's true, I still think a tight trading range is more likely. This is what the bulls want, a breakout test and then a big bull trend. But again, bigger bull bodies here and here. Today is not as strong as that. Today is more like this, or this. Bulls tried to get the breakout test, did not go up high enough for the stop entry bulls to make money, tried to go up a second time and failed, and then we finally fell below the breakout point. But 18 remained the low of the day. So this, I think, is so far the most similar to today. High one buy, but tight trading range more likely than small pullback bull trend. So stop entry bulls, I think, have to use a wider stop, maybe below 14, maybe even below 9. Pull back to around the moving average, and now we have a 6 bar, 7 bar bear microchannel. Are we still always in long? I think so, but I think it's what I've been saying, that we can get a deep pullback here, a lot of bars break out above the 18 bar range, pullback, but still a higher low. So this pullback could easily go for another 5 or 10 bars. Here we pulled back for several hours before the bulls came back. For the bears to flip it to short, they need a pretty strong bear breakout. Right now they're getting bear bars with bad follow through, so still always in long. So this is kind of like what we're doing. The bears tried to accelerate and get a breakout here below the trading range, but it failed. Tested the open and then rallied. Can you sell above 28? Betting that 7-bar bear microchannel a bad buy? I would not. I think we're still always in long, so I think it's still better to be buying a pullback, the current pullback, than it is to sell above 28. But if you're buying, I think you need a wide stop below 9, maybe below 14. We have a buy climax here, so the low of 19 is a target. The bottom of the most recent buy climax is a magnet. Limit order bulls who bought one tick above the one high, betting on a gap, have not yet made money. They probably will. We're still always in long. But I also think this is unlikely to be a big bull trend and more likely to be a trading range. Bulls trying to get a second leg up. They failed here. So this is probably like this. Probably most of the bulls who bought with limit orders are scalping. You can see we're 5 ticks above the one high. A lot of bulls tried to buy at the one high or below the one high. Some bought 1 tick above the one high, and right now they're trapped. It has to go 1 more tick for them to make money. This is similar to yesterday, where we had a tight channel, a pullback, and the bulls tried to go up. So 1 sell-off, 2 sell-offs, 1 sell-off, 2 sell-offs. Here the bulls could not get the third push up to the wedge. We got a lower high, and the bulls are trying to get a third push up, but I don't know that it matters if they succeed, because with so much limit order trading, probably sellers above the 22 high if we get there. For the bears, a lower high, but again a minor reversal, just like this was a minor reversal. The bulls are hoping this is a breakout of a bull above a bull flag, and that 31 is a pullback, and that bulls will buy it and we'll get another leg up. But I think most bulls only want to buy low, the 22 low, the 1 high, try to buy 1 point below. Still a minor reversal. So, even if the bears get a measured move down from the double top, we're still always in long. Is it still 90% chance that we've seen the low of the day? Well, the range is small, so maybe it's 80% chance. And if we start to get a series of bear bars, then 70, 60, 50% chance the lower and lower we go. But right now, it's still likely that we're not going below the low of the day. Sometimes you go above the high of the day and below the low and get a big trend day. That's unusual. Here we fell below the low of the day late in the day. Good bar for the bears. Surprise bar. Surprise bar usually leads to a couple legs sideways to down. Can the bulls buy the 28 low? It's a trading range day, so they probably can, but it's probably better to wait to see what we get over the next few bars. The bulls are hoping the bear breakout fails and that 33 is a bull inside bar, creating a high 2 buy, 2 legs down, 1 pullback 2. And for the bears, I think most bears will not sell this far below the high in a trading range day. Closed above the 28 low, and therefore not a lot of aggressive selling. Most of the bears are scalping. Now you have limit order bulls 28 low. They needed to bounce 5 ticks to make a profit, and therefore there are sellers 5 ticks above the 28 low. And if there are enough of them, the market might stall 4 ticks up and try to get another second leg down. The bears know the limit order bulls need the 5 tick bounce, so the bears will sell 3 or 4 ticks above the 28 low, right around where we are. You also have limit order bulls about the 31 low and more 1 point lower. They need it to get above the 31 low, and those bulls will sell also around the 31 low. Probably doing this kind of a thing, or like this, big bear bar, second leg down, but not much of a second leg down. Then the bulls bought again. Big bear bar, the bulls bought. 2 bear bars, actually 3 bear bars. Bulls still bought. So this is still probably going to be a trading range for the remainder of the day, and probably more of a limit order market than a stop order market. Not a good stop order buy above 28 or 29. Not a good stop order sell below 23 or 27. Not a good stop order sell below 31, and not a good stop order sell below 33. You can call it a triangle or a tight trading range or a bull flag. We're still always in long, so the odds still favor higher, but because of the tight trading range and the very quiet early trading, the odds are we're not going much higher, and that we may simply stay in a tight range for the rest of the day. So stop order bulls, this is a buy, but I think it's better to be looking to buy with limit orders below things than with stop orders above things, and bears probably will be selling and breakout to a new high. Obviously, if we suddenly get an exceptionally strong breakout to new high, bears will not sell, but more likely we're not going to get a strong move up or down, maybe for the rest of the day. Still always in long. Can you put your stop right below 32? Well, it's 2 legs down, 1 pullback 2. I think if you're long, I would use a wider stop, like still below the low of the day. I'm currently flat. When the range is 2 points tall like this, I usually wait, even though we're always in long. The bulls see this as a triangle. The bears see it as a wedge bear flag, bear breakout, and then a double top for 2 pushes up, 1 pullback 2, and then a failed breakout for the 3rd push up. I think it's too tight of a trading range to trade. The goal has to be to make money, and when the range is this tight, it's too difficult to make money and very easy to lose money. If there was an advantage to the Republicans, if there was an advantage to the bulls or the bears, the market would not be doing this. It's doing this because it's balanced. This is one of those small days. Right now it's 5.75 points. And that might be all we get. This day stayed 4.75 points all day. This is similar today, an 18 breakout of the 18 bar range, but still 4 points, and it grew a little bit at the end of the day. Bear version of it, small, got a small breakout, another small breakout, but stayed small. Stayed small, stayed small. If the breakout is earlier in the day, you can get a measured move up. Here the breakout's around 9:30 or so. Here the breakout is around 10 o'clock, and the bulls were able to get a measured move up. Breakout around, 9:30 or so. But when the breakout starts to occur after, 10:30, 11 o'clock, usually if you get a breakout, it's not going to go very far. Here, just one tick. Here, a few bars, not very far. So the longer it remains small, the less likely the breakout will go very far. This is, I think, the most similar to today. We have a bull breakout, and then a tight range, and then a tight range. The range is still small, and therefore the low of the day is not far, and that slightly increases the chances that we can get to a new low of the day. The more we go sideways here, the more neutral it becomes. I still think 70% chance at this point that we will not fall below the low of the day. Also, probably 70% chance the range is not going to get much bigger. We already have 5.75 points, which is a big enough day. You get, many 5.75 days a year. And therefore it's not that exceptionally small. I'm going to highlight the days that have a 5.75 range like today. So here's today. We had 3 here, 1 here. So this year we've had, 8 or 10. Last year everything was big. So not a single day under 5.75 or 5.75 or less. In fact, you have to go back several years to get another 5.75 range day. So 2015, 2016, none. But then 2017, we've had, this is the 9th one. Therefore, it's not that unusual, about once a month. And over the past month, we've had 3 others. So that increases the chances that we can have one today. The odds favor a little bit higher, but not a lot higher. Still always in long, but not many traders willing to buy up here. Most traders are aware of this stuff, that if the day is very small, and then late in the day, usually you do not get much of a breakout. whenever day is small, the open of the day is a magnet late in the day. You can see yesterday was pretty much a doji day. Then we had 3 doji days here. Prominent tails closed around the open. That increases the chances of today being another day, small day with the close around the open. Therefore, if we're not too far away from the open late in the day, the bears will try to get back down to test the open. Bears want a double top major trend reversal, but the odds of much of a reversal are small. We'll probably stay mostly sideways for the rest of the day. Open of the day is a magnet, so I think we'll get one test down to it. It's possible we could break below it and get to the low of the day. It's possible we just stay down there. It's possible we try to test down and reverse up. Similar to today, small day. Here's the open of the day. And the market came back down and tested the open late in the day. Open of the day, fairly small day. The market bounced off the open, could not stay up, and eventually came back down to around the open. And the day ended up as a day with a big tail on top. Open of the day, resistance, support, and the day closed right around the open. Another fairly small day. Weak rally after 11 o'clock, came down to the open, bounced, fell below the open, new low of the day, but came right back to the open. Open of the day, resistance, and then sideways, and ended up closing on the low, but not much energy. Tested the open, and then mostly sideways. The bears could not get it down to the open, and we reversed up, and that increases the chances we'll close near the high of the day. Here's the open. The market tested it, tried to reverse back down, they bought it, and we ended up closing at the high of the day. But again, not much movement. The open is a magnet, and then from there, it could go back to the bottom, it could go up to the top. Usually does not go too far. Rally, tighten channel, lasting almost 3 hours, but fairly small day. The market worked its way back down to the open and found buyers, and we got a close on the high, so the day ended up as a small bull day, open down here and close up here. But again, the open was a magnet. And today the open is a magnet as well, but it's only 4 ticks below 61. So it will not take much selling for the bears to get their test. Bulls want a double top major trend reversal, perfect double top, but tight trading range, very quiet trading. Tomorrow, FOMC report at 11 a.m., a good reason for the market to be quiet going into the report. All of that reduces the chances of a big move before the end of the day. Look at the bars. A lot of 1 tick, 2 tick tall bodies, and then a 2 point tall range. Usually the market's not going to go very far. That's the minimum objective, a test of the open, and then we see what the market does. Does it stay around the open? Probably does not. Probably does not get much. Probably does not get far from it. The bears want a double top, break below the neckline, and a measured move down. But even if the bears get a measured move down to the low of the day, the odds are it'll come back to the open by the end of the day, and the day will be a second consecutive doji day. Yesterday was a small doji inside day, and today so far is an inside day and a smaller doji day, and that's probably how it's going to end, whether or not we go down for another point or two. Just like bulls would not buy far above the moving average when they knew the odds were we were going to come back to it. Bears will not sell too low because they know the market will probably get back to the moving average again if they get it below. Like this, the bulls got a bounce, could not stay far from the moving average. The bears got a breakout, could not far stay from, not the moving average, from the open of the day, and then back to the open of the day. So support, too far, extreme. Broke through it, too far, extreme, and then back to it. We might get this kind of a finish. Bear bar, 63, but not big, only a 4-tick body and a 2-tick tail below. Does not look like we're going to collapse below the open of the day. Probably will resume this trading range. For the bulls, they have a bull flag, a breakout, and a pullback, but I think it's going to be really hard for the market to go very far. It can always happen, but look how tight the range has been for 4 hours now. So probably not going to go very far up or down. Probably will stay around the open of the day for the remainder of the day. So far today is an II on the daily chart and a doji bar after yesterday's doji bar. So I'm trying to get neutral going into tomorrow's FOMC report. If the day was not a small day like this, traders would buy that 68 low, betting on the failed reversal. But with the day this small, I think most traders do not want to buy too high, especially since they know the open of the day is a magnet, and it's still likely that we're going to close the day within a point of the open of the day, even though we're working higher. It's going to have a hard time getting far from the open of the day. You can see it went 5 ticks above the 68 low and immediately reversed down. That tells you that most of the bulls who bought the 68 low were scalping. Actually, for stop entry bears, it's a second entry short with 68, but I would not sell. We're within 4 ticks of the open, and chances are we're going to have a hard time getting very far from the open. A bull, II, but buying near the high today has not been good. Buying above bar 2, buying above 27, 28, or buying above these bars, and buying above 59, buying above 68. I'm not willing to sell with a limit order this late in the day, but I'm also not going to buy that high. The bulls want to buy deeper down, like down here, 5, 6, 7 ticks below the high, not 2 ticks below the high or 1 tick below the high. We're always in long. We've been always in long since bar 11, but over the past 4 hours, almost 5 hours now, buying anything other than a point or so below the high has been a bad strategy. You can always say, well, it's always in long and therefore I can buy for a swing. Well, if you have enough time left for a swing, you can. This could always surprise us and quickly go up for a measured move based upon the sell-off, right? Whenever you have a sell-off, I think of the rally as an attempt at a double top, even though we did not pause here. Instead of breaking below the neckline and falling for a measured move, very often it'll go above the sell climax up for a measured move. The math is just bad. The probability of more than 2 points up is probably 30%. So therefore, the math is bad for a swing up, and then for a scalp up, if you're buying it, you're risking 6 ticks to make 4 ticks. Do you think it's a 70% bet, 80% bet? And it's not. And therefore, I cannot buy for a scalp, and I cannot buy for a swing above 71. And that does not mean that you can sell there. Just because it's a bad buy does not mean it's a bad sell. Just look at here. Lots of bad sells, lots of bad buys. The market can simply go sideways, and then neither the bulls nor the bears make money. I've been saying all along that I think we're going to close around the open, or within a point of the open, and I still think that's the case. You can argue 3 pushes up, 1, 2, 3, but this is having a short fairly low from the high, and the obvious target is the open, and it's the opposite of buying above 71, right? A swing is unlikely, and we have support just a little bit below. So you sell below 72, your stop is above, so you're risking 7 ticks to make 4 ticks, and I don't know that the probability is worth it. We're in that window when the market can have a buy the close or sell the close finish, but when the market is in a tight trading range for 4 hours like this leading up to the end of the day, the odds are against much of a move at the end of the day. Where can the bears take this? How far down can they go? A weak rally. The bears still want leg 1, pullback leg 2, but support at the open of the day, the bottom of the tight range, 60-minute moving average. Probably most bears who did sell either below 68, bad idea, or below 72 will scalp and take profits right around the open. By the time it's clearly sell the close or buy the close, there's not going to be much left. And when the market looks like this, the probability of trading buy the close, sell the close is low. Chances are when it looks like this, it's not going to become a trend in the final 30 minutes. $12.15, trading range day, but bigger moves than today. The bears did get sell the close. This was a bear trend day all day, so a higher probability of a sell the close. Same with here, bear trend day all day, so no surprise the trend continued into the close. This is kind of like today. Very tight range, tried to break to the upside, tried to break to the downside, and then at 12:35 we got 6 bars down, but by the time you decide it's sell the close, you're already right here or here, so you're not going to make much profit. Here, big bull day, so there's much more energy, so there's a better chance. Plus, we were selling off here for for a number of bars. Tried to get sell the close, and the bulls bought it to a double bottom, higher low, major trend reversal. Tried to reverse and sell the close, but by the time you decide it's sell the close, there's not much left. Trading range today, but again, more energy than what we've had today, so a better chance of a move at the end of the day. this is what the bears are hoping for. But even this day, we had more energy, pretty sharply up, pretty sharply down. So the odds are we're going to stay right around the open, and the day will be a doji inside bar forming an II on the daily chart. Consecutive inside bars going into the FOMC meeting. Too late in the day for me to buy the close 73 or to buy the low 74. Also, we're at the magnet that I've been talking about all day, and the odds are we're going to have a hard time going more than a point or so from it. We have support below 60-minute moving average and resistance above a micro double top. As I said, sometimes when you have a small day like this and a test of the open, the market has a few bars and you're suddenly at the low, or a few bars up and you're suddenly at the high. But by the time you decide it's going lower, there's usually only 1 or 2 bars left and hard to make money. This is what the bears are hoping to get. If you don't trade during all of this, now is not the time to start trading, hoping that the market is finally going to be different. By the time you conclude it's different, there's very little left to the move. The odds still are today's going to remain with a small body, in other words, a close around the open. So I know it's tempting to sell. We broke to the upside, it failed. We reversed and we broke to the downside. Maybe this will succeed. But the math, I think, is not very good. Bitcoin has been getting a lot of coverage on TV and internet. This is the daily chart of the GBTC, which is the ETF that follows Bitcoin. I really think they need an ETF that follows a basket of cryptocurrencies, Ethereum, Bitcoin, and a few others, because chances are one or most of the cryptocurrencies will disappear. And to bet that Bitcoin is the one that will survive, I don't know that the probability is worth the bet. One of the reasons why the reward is big is because the risk is big. Some people who are hoping to capitalize on the cryptocurrencies will buy many different ones, and that way if one succeeds, they'll have a winner that might return 4 or 5 to 1, and the 3 or 4 that disappear, they'll go to 0, will be offset by the big winner. I remember a friend of mine in Los Angeles, Dick Reardon. He was the mayor of Los Angeles for a while. He was into venture capital, and he used to buy or heavily invest in the 80s in a whole bunch of startups, knowing that most of his investments would lose 100%, but every now and then he would get one that would return 10 to 1 or 1,000 to 1. I guess it was in the 70s that he inherited some money after his father died, and I forgot how much he inherited, and I forgot how much he put into it. But anyway, I believe that he put $500,000 into a startup called Convergent Technology, and over the course of just a handful of years, his $500,000 turned into $100 million. Instead of just an ordinary, wealthy lawyer, he became extremely wealthy. $100 million back in the 80s was serious money, and it's the reason why he ended up becoming mayor. He had a lot of money. When you have a lot of money, you have a lot of friends. However, as I said, he invested in a lot of companies that went bankrupt. He was giving them startup money, hoping that the idea that the company had would succeed. And then he got a 200 to 1 return on one of his investments, and that changed his life. But only rarely do you get that kind of return, 200 to 1. But however, if you get a 200 to 1, you can lose 100% many times. You can lose 100% 200 times and still be break even. But anyway, that's what I think is going on with the cryptocurrencies. I don't know how big they'll be. I doubt that all will survive. And if you're buying them, yes, you have the potential to make a lot of money, and that always means that the risk is big as well. So it's not as if they're only going up. It would not take much of a concerted effort by different governments to tell the cryptocurrencies that you can't be so crypto. You have to let us figure out who's hiding money. And a lot of the cryptocurrencies won't survive that because a lot of people put their money in it because it's crypto, it's hidden. It sounds like Paul Manafort, I don't know if he was using cryptocurrencies. He had apparently, or the accusation that I read is that he had multiple international accounts and he was taking payments for his services in those international accounts, and then he was drawing from those international accounts to buy things, cars and houses in the United States. And had he not been a public figure and had the investigation of Trump's people not taken place, Manafort probably would have gotten away with it. I'm sure that there are a lot of very wealthy people who take their chance. They'll move money around in international accounts, hide it, don't pay taxes on it, and then they live very wealthy lives in the United States. If you think about it, let's say you're in a total state and federal tax. Let's say you pay, 45%, right? And then you decide you're going to go ahead and try to hide all your income in foreign currency, in foreign accounts or whatever else, Bitcoin, right? That means that you're basically getting a 45% return a year, because instead of, let's say you make, $100,000, you make $100,000. Obviously, you're not going to pay $45,000 in taxes, but I'm just trying to use an easy number. So let's say you make $100,000 and you had to pay $45,000 in taxes. At the end of the year, you have $50,000 or $55,000. However, if you hid the money and paid zero taxes, you'd have $100,000. So you would have $100,000. The guy next door who made $100,000 would have $55,000. So you basically made twice as much money as he did by hiding your money. And I think that's the accusation, or one of the primary accusations against Manafort, that he was hiding money and not paying taxes on it. And the incentive is huge because, like I said, if you pay your taxes, you end up with $55,000. If you don't pay your taxes, you end up with $100,000. So it's basically, by not paying a 45% tax, you make 80% more money. 100,000 is like 80% bigger than 55,000. So that is the incentive, and that's why a lot of people do it. I'm a really, really honest guy, and honesty was really, really important in my culture growing up. And I would never in a million years even consider doing anything like that. However, I have met people who have done it to varying degrees, and I gotta say, just from a personal point of view, I'm kind of mad at them and I don't really associate with them. I bump into them every now and then, but I don't want them as friends, because in a way I feel like they're cheating everybody else, and I kind of feel like we're all part of an extended family, and we should all be pitching in to help. And so, I don't know. For me, it's just I'm uncomfortable with people like that. Three pushes down. Is it sell the close? Sure, but you want to sell the close here, right? Bear bar, bull bar, bear bar, bull bar, and then a couple dojis, bear bar. What do you think? Is it going to be a big bear bar, sell the close? If anything, you're buying the close. You're buying the 60-minute moving average, betting that we're going to end up at the moving average. So if you buy the close, where's your stop? Well, probably below the low of the day. So you're risking about 3 points to make 1 point. And is the probability, what's the probability? I would say 60%, but you cannot risk 3 points to make 1 point if it's a 60% probability, because, the 40% of the time you're losing, 2 or 3 points. You may only lose 1 point. The market may just go right here and then close the day right here. But anyway, you're losing too much to go for a 1 point profit. And can you make more than a 1 point profit? Can we do this at the end of the day? Well, this is bar 77. Right? At the end of yesterday, bar 77 was here, and the bears got a 2-bar move. It's unlikely that we're going to go very far. So the math is really difficult. You can see some bulls bought the close because of a parabolic wedge. Bear, bull, bear, bull, bear, and they're betting on bull again, and they're betting on the magnetic pull of the open of the day. But I cannot. I personally did not take the buy. All right, but the only trade if I was forced to take a trade, I would buy the close of 77 and bet that the follow through would be similar to the close of 70 and the close of 73. Bar 78, you can see it going up and down and up and down, 2 or 3 ticks up, 2 or 3 ticks down, telling you that there are a lot of big trades taking place. Actually, that's a pretty small bar 78. No, it's not. It's 200,000. So, you look all day, some of the bars are 2 ticks tall, and then bar 78 is 205,000, 206,000 contracts. Why do you think that is? Why would bar 78 in a very small day have 200,000 contracts? Okay. Well, what's today's date? It's October 31st. And you can say, well, the last day of the week often has big volume, bar 78. The last day of the quarter almost always has big volume, bar 78. But October is not the last day of the quarter. It's last day of the month, but it's not the last day of the quarter. What is it about October 31st that would explain such huge volume on a day where the market has been barely trading at all? Some of these bars are 2,000 contracts, not even 2,000 contracts. Okay. Well, it's because, and I could be wrong about this. I know it was right years ago, but I still think it's right today. The mutual fund fiscal year ends on October 31st. So this is the final bar. Bar 78 is the final bar of the fiscal year for mutual funds. Remember, I told you that the close of November 5th is above the close of October 26th a high percentage of time, like more than 90% of the time. Again, I have not confirmed that. I haven't looked at that in 10 or 15 years. About 10 or 15 years ago, that was true. And I forgot what the percentage was, but it was better than 95% that the close of November 5th is going to be above the close of October 26th. So that force is also operating on the market. And I've always thought that was because of the mutual fund fiscal year ending October 31st. That doesn't explain why the bullishness extends into November 5th, but when I was doing the calendar trades, searching for different optimum windows, I thought November 5th was better than November 1st, or at least the results looked like it was better. And it might be that on the first of the next year, which is November 1st, those mutual funds have to do something. Maybe they have to readjust their portfolios and have to buy a bunch of, premium stocks, and maybe that creates a slight bullishness to the market. If you're buying stocks with more beta, more movement, and money goes into them, and the money's leaving stocks with less volatility, the result will be a disproportionate effect on the market. So it's not like you're taking dollars and just out of one stock and putting them in another stock that's identical. You're not. You're taking dollars out of a stock that's not moving, and you're putting them into a stock that is moving. And if enough dollars go that way, the stock goes up. And if enough funds do it with enough dollars, the overall market can go up. So that might be part of that bullish influence that takes place end of October, early November. So anyway, weekly chart, so far an inside week. Last week was a big outside week, and today was likely to be an inside week. Or if this week was going above last week's high, it probably would not go much above last week's high, because last week, even though it had a bull body, it was simply a big doji, and that is not a high probability buy signal bar. So this week was either going to stay inside of last week or not get much above it. I say that, but we got two big catalysts this week. Tomorrow's FOMC announcement at 11 o'clock can result in a very big move. And I'll talk more about that tomorrow. One point I always make is FOMC, when the announcement comes out, 50% chance the market is going to move in the wrong direction. Here we went down, wrong. We went up, wrong, and then it went down. So because of that, if you're taking a trade, here, huge day, right? But look what it did when the announcement came out. It fell 10 points, right? So if you saw it going down and you sold, you'd be selling way down here, and by the time you decide you're wrong, it's up 15 points, right? So I would say only once a year will I trade during the first 10 minutes. I usually wait for the first 10 minutes because 50% of the time the initial breakout fails and reverses. So 50% of the time it does succeed, but 50% of the time it goes the wrong way and reverses. Here's one where just a little bit wrong way, but so this is I would call this a successful breakout on the report, whereas this one, it was unsuccessful and then reversed. And because the movement can be big like this, you have, I think it's better to wait until the close of the second bar. One of these times, the FOMC, the Fed, is going to announce basically that it's going to stop quantitative easing, basically printing money. And a lot of the reason why the stock market is up is because money has been easy to get. And so companies can borrow money cheaply, and they can use a lot of their money to buy back their stocks. And if the company becomes a buyer of the stock, what happens to the stock price? It goes up because you have a buyer, and not just a minor buyer. If the company's buying back its stock, it's not going to buy, 1,000 shares of Apple. Apple's going to be buying billions and billions and billions of dollars at a time. So, anyway, so if the Fed stops doing what it's doing, and it will, it has to eventually stop because the debt that the United States and all countries around the world is accumulating it's actually unimaginable. And I don't know what, if there's any 20-year-old out there listening to me, I don't know what's going to happen to you when you're my age. I don't see how the math works out that the country borrows as much as it does. Yes, the economy is growing, but the debt, I don't know, I'd have to look at graphs, but it seems to me that the debt is growing too fast for compared to the growth of the economy. And that means at some point you get a debt crisis, and you either default on your debt or you print a lot of money, and then the dollar becomes worth a lot less. And stocks can actually go up when that happens. If you think about it, let's say Apple is, let's find exactly what it is right now. Okay. So Apple today is $169, right? And let's say the government has to print incredible amounts of money, like 5 times the amount of money that there is now, or 10 times the amount of money that there is now. What's going to happen to Apple? Well, if everybody, instead of making a minimum wage of $10, is making $1,000 an hour, right? Everybody's going to have a lot of dollars, and they're going to do something with their dollars. Some of those dollars will go into buying Apple, and therefore Apple can quickly go up to $1,000 or $5,000. So the stock market can go way, way up in the face of the government doing something incredibly stupid, printing all kinds of money to devalue all the debt, so that let's say I owe you $1, but I own a printing press and I could print millions and millions of dollars, right? So I'll pay you back $1, but the dollar is worth a lot less than before I printed millions and millions of dollars. And that's one of the things that governments can do to take care of debt. So if the government owes $20 trillion, right, one way to get rid of that debt quickly is just print $1,000 trillion, and then all of a sudden $20 trillion is not significant. However, if the government ever needs to borrow money again, who's going to lend it to them when they know the government gets rid of its debt by printing money and making the debt worthless? So anyway, let me get back to what we were saying. But anyway, my point is, at some point, the government is going to decide that quantitative easing, printing money, making money available, has reached the point where it's creating more of a problem than a benefit. And everybody knows we're right around that point. Nobody knows exactly where that point is. However, at some point the Fed's going to say, this is it. They're going to say over the next 6 months, we're going to phase out quantitative easing, and then we're going to stop it completely. And when they say that, the stock market then knows the pump, the flow of new dollars readily available to everybody, especially to corporations, is being turned off. So there'll be fewer dollars coming into the system, and the stock market is being held up by a steady inflow of new money. The government's just basically printing money. So it's creating money out of nothing. They're just saying, okay, we're going to make new money today. And a lot of the price of the stock market is based upon the government continuing to make new money, just inventing it. They're just saying, okay, we're going to print new money today. And that's going to stop. And when it does stop, the stock market is probably going to get a pretty good correction. There are different ways it can correct. It can correct by falling down, big, like here, lose 60 or 70% over the course of a couple of years, or it can do this, correct 15, 20% and go sideways for a couple of years. And, we don't know what kind of correction we'll get. This is the monthly chart of the E-mini. But when the government stops printing money, what we're going to get is some kind of a correction. What took place in the 70s, the 70s is when I started paying some attention to the stock market, was that this is the 70s, 1970s, okay? For 10 years, the market was sideways, right? And I assumed that when the government turns off its quantitative easing, we're going to go sideways for a lot of years. It's possible we could just go down sharply for 2 or 3 years. More likely we'll just go sideways for a lot of years. Even with this, the stock market still lost 40% here. 20% here, 20% here, 30% here. There are a lot of big swings, but the market, stayed in a range for more than 10 years. And, I think that's probably what's going to happen. There's not much risk of it now. This is the Dow monthly chart. When the stock market looks like that, it ain't going to do this. It first has to do this. And, this took a year to transition from a bull trend into a bear trend. And therefore, the downside risk over the next year or so, next 6 months or so, is not great. However, we could do this, right? Buy climax sideways. Buy climax sideways. We could go sideways for a year or so. So we had a bull trend for a few days here, and then a deep pullback, big up, big down, big confusion. You expect sideways. The traders are confused. That means they're not confident that it's going to go far down. They're not confident that it's going to go far up. That means they tend to buy as it goes down and take quick profits, and they tend to sell as it goes up and take quick profits. And the result is a trading range, and that's what we've had for a couple of days. The bulls are hoping that this trading range is a big bull flag after this trend, and that we resume up to a new all-time high, like after tomorrow's FOMC report. And the bears are hoping that it's a lower high major trend reversal and the start of a massive trend down, or at least a 5% trend down over the next couple of months. The market's in a bull trend, and because it's in a bull trend, you have to assume that every reversal attempt is going to fail, and that has been the case for the past 6 months. And the odds still are every reversal attempt will fail. However, the odds are also getting increasingly good that one of them will succeed. By the time you believe it has succeeded, it's probably already gone at least 50% of the way to its final target. And that's always the case with reversals, bear trends. Traders keep buying pullbacks until one pullback does not resume up. And by the time they decide that it's the start of a correction, the correction is already half over. So tomorrow, we've been neutral 5 hours here, neutral all day here. Bears are hoping for a lower high major trend reversal. Bulls are hoping that the bull channel continues up, higher lows, lower and higher highs. On the open, first bar of the day was a warning that today's going to be a really boring day. It's a small bar. It closed on its low, so it could be a failed breakout of yesterday's range and the start of a bear trend day, but it's a small bar. And I said at the time, it opened on its high. And therefore, there was an 80% chance that even though it was a bear bar, that we were going above the high of the day at some point today. It took a couple hours to get there, but we got there. The bulls, an opening reversal up, a sell-off testing the top of yesterday's range, but a bad buy signal bar. And then the bears had a better sell signal bar. Now it's a second reversal attempt down from the breakout above yesterday's range with a decent bear bar. So probably going lower, but it may simply be a 50% pullback to the moving averages, which it was. And then we had a high 2 by bar 6, but 2 big bear bars and a small bull bar. Probably we'll need one more leg down, which we had on bar 9, but it's a doji bar, so not a very good buy bar. However, bar 11 consecutive bull bars, chances are this is an opening reversal and an early low of the day. And then up here, you can call it a parabolic wedge. It's a small range day. The bars are small. And I said, looks like it's going to be a continuation of this and this, that we're probably going to stay sideways for an hour or more, maybe the rest of the day, and then close around the open of the day. And today would end up as a small doji day, closing around its open, and inside of yesterday's day. So now we have an II going into the FOMC tomorrow, which is what we have. So anyway, we get the breakout on 22, buy the close. You could buy the 22 close, but to do it, you probably have to be trading small and willing to scale in lower. And 30 got up to the 22 close and reversed. So a lot of the limit order bulls about the 22 close were so eager to get out after seeing this that they placed a limit order 1 tick below the 22 close, and they were willing to take the 1 tick loss here. and then sideways forever, and then resumption, a little reversal down at the end. So stop entries today, below 4 made sense, above 9 might be okay, higher probability to wait until 10, and now we're always in long, so it's higher probability to buy for any reason below 12, above 14, probably above 18, because we're 18 bars into the day, 90% chance we've seen either the high or low of the day, and the momentum up is pretty good, so we're probably going at least a little bit above the high. However, the bars are small, the day is quiet, we're probably not going much above the high before we go sideways. So buying above 18, okay. And then here, stop entries were just bad. Selling below 23, below 26, below 31, below 35, any of these, and buying at the top, buying a breakout of anything above that bear bar, above these bars, above here, above here, above here, all bad. The only one that I thought made sense was, actually, I'm buying above 38 was probably okay, 47 was okay, 52 was okay, and the ones who bought 52 or 47 made money here. The ones who bought 33 or 38 got a 5-tick trap and they get out over here. For the bears for stop entries today, higher high major trend reversal, lower high major trend reversal, double top major trend reversal, lots of major trend reversals. But we knew that 4 hours, 5 hours into the day, and the day is small, this day is not going to go very far. So not a good swing setup for the bulls or for the bears. Traders will continue to scalp. Up here, selling below, we have an II-71, and a failed breakout. We should get to the open, but we may simply get down exactly to the open or a tick or so below. So not a great sell below 72. Bears tried to get sell to close, but like I said, it made more sense, if anything, to buy the 77 close, parabolic wedge, 1, 2, 3, betting against the sell to close finish and betting on a close near the open. Buy the close, sell the close. I thought the first reasonable buy the close was 11, and then through here it's a tight channel, buy the close. And then when you get 22, a bigger bar, if you get 2 consecutive bigger bars, then I often will buy the close of the second one. But if I just get 1 bigger bar, chances are it's an exhaustive end of the move, and that means the market's going sideways, which it did. And then buy the close, sell the close, none of it. I would not do anything here. Limit order trading. If you're really aggressive, you can sell the 2 high. And I thought 4 or 5 was strong enough, so we'll go a little bit lower. So I thought selling the 6 high was okay, but not great. And I also thought buying the 6 low was probably okay. Weak sell-off, bars not big, reversals, 60-minute moving average, probably not going all that much lower. 12 low, probably okay, 17 low, okay. And then if you're really aggressive, it's all limit order trading here. You buy the 23 low, you try to buy more lower, and then you start selling. Well, I would not sell above bars. Up here, I don't like to sell above a bull bar. You're selling above 32, but I don't want to be selling above there. And then maybe at the high of the day, if you want, I'd rather be focusing on buys. I don't take many of them, but I'm looking to buy below bars, especially bars that are not bear bars near the bottom. And sometimes I'll take a stop entry buy. So buying below like 34, buying below 23, try to scale in lower, unable, and you get out break even when it gets back above 23. Buying below 49, bear bar 50, but still probably okay. And then here, I'm not buying this high up. And, selling above 59, it's the top of the range, but it's a bull bar, so not good. The same with selling above 71. So not a lot of trades today. And when the market does this, I usually take the first trade or 2 and then just wait for it to do this. And then I try to get 1 or 2 more trades and then wait for tomorrow. The question, I always find it difficult to enter with a full position because I'm always contemplating scaling in advance. I think that's okay. I traded with a guy, I don't know how long ago, 20 years ago, every day. I traded with him for years, and his basic position size was 4 contracts in the E-mini. Back then it was, actually when I was trading with him, was it E-mini or just the full size? I remember it was probably the E-mini. But anyway, he was trading 4 contracts, and he would scale in twice. So his total position would be 12 contracts. If he put a trade on with 4 contracts and it went his way, he would not have to scale in. He would just take the profits on the 4 contracts. A lot of times it would go his way after his first entry or his second entry, and he would never put his third position on. And that meant, I think, probably 70% of the time, 80% of the time, he never had a full position. So he never had 12 contracts on. Most of the time, he had either 4 or 8 contracts on. And it didn't bother him, didn't bother me. It made sense to me. So, I think it's perfectly fine to trade small. If you're thinking that you're willing to scale in, then you have to trade small. If you're thinking that it's unlikely that you'll scale in, then you can trade a full size position. Can you show some valid entries and exits for trades today, a small day? The kinds of things that I would do, selling the 6 high for a scalp, and then buying somewhere down here, maybe the 9 low, the highest probability trade. Selling the 4 low I thought was okay, but I thought it'd be a scalp. I thought we'd get to the moving average. I didn't know that we'd get much lower. And then buying the 12 low, stop below 11. We'll probably get at least a small second leg up. And then once we broke above the high of the day, it turns out the bulls who did buy on a stop at the 1 high made money. But I'd rather buy a reversal down, either with a limit order at the 21 high or with a limit order at the 1 high. The odds were the breakout would pull back below the 1 high. So for me, I'd rather be buying with a limit order at the 1 high and looking for a 1-point scalp. And I was not alone. You can see it went up exactly 5 ticks and then reversed down. And that shows you that a lot of the bulls did exactly what I said. They bought with a limit order at the 1 high and placed a limit order to get out with a 1-point profit. And then here, I think buying above 38 was okay. I thought it was basically like a high 4. We tried to get a double bottom here and then another double bottom here. I thought this was the highest probability of all of them. The bulls tried twice here, could not get it. Tried a third time here, and then they tried twice more. Again, bull bars closing on their highs just above the moving average, always in long. That's usually a pretty good buy. And you could probably, if you bought above 52, you could probably put a tight stop, below 52, maybe a tick or two below 32. Because at that point, the odds were high that we were going up at least a little bit. And then selling below 72, I debated it and I ended up not taking it. We got a failed breakout above the high of the day. We got a magnet at the open of the day, but it's only 5 ticks down, and we have to fall 6 ticks to make money if I sell below 72. So, but I think most traders on a day like this should, take 1 trade, 2 trades, 3 trades maybe, or not trade at all. I think it's just the math is very difficult to make it work out. And especially if you're starting out, you're going to make mistakes. And, if you're only going to be taking 1 or 2 trades, and then you make 1 mistake, you've erased the good stuff. So, especially once it's in a 2 or 3 point range, most traders, I think, should just wait it out and wait for tomorrow. Question, does it make sense to take a lot of 2-tick profits, or do you always go for at least 1 point? I talk about that in the trading course. Let's say your round trip commission is $5. It might be a little bit better, but not much better. Okay. So if you take a 2-tick trade, you make $25, but you have to pay $5 commission. So your net profit is $20. And let's say you use a 2-tick stop. So when you lose $25, but you also lose the $5 commission. So you actually lose $30. So every time you win, you make 20. Every time you lose 30. And that means just to break even, you have to win 70% of the time. And our you a good enough trader to win 80 or 90% of the time? Because that's what you have to do to make a living doing it. And if you're risking 2 ticks, the probability is really not going to be good. So if you're trying to make 2 ticks, you almost certainly have to risk more than 2 ticks, and that means that you have to win, 90 to 95% of the time to have a profitable strategy. And if I concentrate really, really hard, I can do that, but it also, it's not as fun. So so yes, a lot of days I don't have any losers, but if I'm forcing myself to be perfect by scalping for 2 points while risking 2, 3, or 4 points, at the end of the day, I may have 2 or 3 points profit, and I'll look back and I'll say, well, if I just went for 1 point scalps and used a wider stop, I could end up with quite a bit more profit. So for me, in the course I talk about minimum scalp sizes. For the E-mini, I think no one should ever scalp for less than a point. For Forex markets, I think no one should ever scalp for less than 10 pips. For a cheap stock, like a $10 stock, I think no one should scalp for less than 10 cents. And for an expensive stock, like a $100 stock, I think no one should scalp for less than 50 cents, because it's simply hard to make money going for less because of what you have to risk to make the profit. So to answer your question, even though the range is very small, each tick is still too big, and it's just really hard to make the math work out. To make 2 ticks, the market has to go 4 ticks your way, and if you get stopped out, it's almost impossible to do it risking 2 ticks. So to make 2 ticks, it has to go 4 ticks your way, so you need a 4-tick move, and you're risking 2 ticks. I think it's just really hard to do unless you're willing to scale in. If you can scale in, then you could possibly make money trading 2 ticks. But if you're going to be using limit orders and scaling in, I think it makes much more sense to go to 4 ticks because of the problem with commissions. When you're trading 2 ticks, the commissions are basically 25% of your profit. $5 commission out of a $20, 20. If you're going to net $20 and you have to pay a $5 commission to do that, and when you lose $30. I think the commissions just become too big a burden, and then you add to it slippage and mistakes, and I think it's impossible to do it consistently. So I would never scalp for 2 ticks. I often take 2 ticks profit or 1 tick's profit, but I do not go into a trade saying I'm going to go for 2 ticks. I'll only go into a trade if I think I'm going for at least 1 or 2 points. But if the trade does not materialize the way I expect, then I sometimes will get out with 1 or 2 ticks, sometimes a 1 or 2 tick loss. Okay, hope everybody has a good night.